Santanu Sengupta, Chief India Economist at Goldman Sachs, joins us for that conversation. Mr. Sengupta, thank you so much for your time with us here on NDTV Profit, and great to speak with you at a time when I would say the Indian economy is in focus for us here domestically, of course, but definitely what the US and the White House announces also becomes a big picture. So let me begin with your take on some of the key data that has come out of the budget presentation this year, namely fiscal deficit. We're sticking to our FRBM targets and the nominal growth outlook of 10.1%. Did you find the growth outlook a little underwhelming?
Well, at a time when India is going through a cyclical slowdown, which has been our view, mainly driven by policy, around 10% GDP growth on a nominal basis isn't too bad in our view. We think that the consolidation path that the government has stuck to has been unwavering, so it's really showing their commitment to the fiscal consolidation. But what we are seeing is that the drag on growth from this fiscal consolidation going into FY26 will be lower than what you've seen in FY25, because in FY25 you were consolidating from 5.6% of GDP to 4.8% of GDP, which is 80 basis points. In the next year, you will be only consolidating by 40. So it'll still remain a drag, but at least the drag will be lower than what we have seen in the current year.
In terms of the impact of tax cuts, and that's really the big headline coming out of the budget, Mr. Sengupta, in terms of the impacts on tax cuts to actually boost consumption, we've been hearing so many views on this. Keen to know what your take is. Will this really mitigate some of the pain on urban consumption?
Yes, so the tax cut is very targeted, and the government has been very conscious in terms of targeting the urban consumer tax-paying population. Look, the total number is about 0.3% of GDP, about 1 trillion INR. Our sense is that part of this will be used by, especially in the lower income brackets, to deleverage, because you have gone through this unsecured lending stress over the past year. At the very top end, which is 25 lakhs and above income, possibly there's going to be some saving. It's really in the middle that we are thinking that this will go into consumption. Our sense is that this goes into quite a bit of services consumption and some discretionary consumption. We are less certain if this is very positive for staples consumption, but for discretionary, both goods and especially services, this should be good. But remember, there's a part which is being used for deleveraging and a part which is being used for savings, which doesn't get into consumption straight away. However, if you're deleveraging the balance sheets, then this sets you up, especially with the rate cuts view that we have this Friday and thereafter one more, and the liquidity easing by the RBI. This sets you up for another leverage cycle, possibly later on in the year, maybe in the second half. But overall, as I said at the beginning, fiscal will remain a drag. Within that, you're having this very targeted boost for the urban consumer.
Santanu, good morning. Neeraj here. I was reading your note wherein you are mentioning that the income tax collection targets are somewhat optimistic. I would just love to know that we have had a weak H1 due to idiosyncratic factors in FY25, and quarter three also has not set the stage on fire. In that sense, growth hasn't been that great. On that base, if the GDP growth looks a bit better in FY26 and tax collections and businesses look a bit better than FY26, why is it optimistic and not realistic?
So particularly on income tax, if you see they're moving from 3.9% of GDP in the current fiscal year FY25 to 4% of GDP next year. Now this 3.9% of GDP is already at 30 basis points of GDP accretion over FY24, which means that income tax, even as the economy has been slowing through the course of the year, income tax has been surprising us on the upside. After you dole out 0.3% of GDP in terms of tax relief, whether you can do 0.1% of GDP better over the current year is where we are feeling a tad bit optimistic in terms of the budget assumptions. However, I would say on aggregate, the receipts assumptions are fairly realistic. So, they should be, 10 basis points of GDP in a very large budget, the government should be able to adjust by the end of the year. But particularly on income tax, we thought that moving from 3.9 to 4% of GDP, while you're giving out this 1 trillion INR or 0.3% of GDP tax relief, was just a little bit optimistic.
Santanu, the other thing is this whole thing around Capex, right? Yesterday we had a market guest who was mentioning that the incentives being given to states as well for doing the Capex, and the fact that there has been a 3-year cycle of fairly heightened Capex, after which FY25 has looked slightly curtailed. Is it okay for an economy in the life cycle that India is in to do 3 strong years and then not pause literally, but kind of consolidate Capex, before which maybe an uptick could happen again as well? Because a nation can take that decision, say after FY26, right, that we want to get back to Capex. Consumer has been hurting, so you're focusing on the consumer for the time being. We can always move back the needle to Capex if indeed tax buoyancy and other things work, stay okay. Is it okay for a country in the life cycle that India is in to take such a move?
I think the background is important. Over the last 3 or 4 years, India has been consolidating the fiscal deficit. So you've been bringing down the fiscal deficit every year. And every year you've brought up Capex, which means that something else had to take a hit to make the budget math work. And credit to the government that they moved up from around 1.5% of GDP pre-pandemic to around 3% of GDP plus right now. But as you're consolidating the deficit further, it's very difficult to allocate more for Capex. So I would actually give credit that they have at least maintained Capex as a percentage of GDP around 3.1, which means that you're growing around 10% year over year. Some of the baton is being passed on to the states. At some point of time, once the global uncertainty recedes, you will hopefully have private corporate sector also keen on putting up capacity. But it's difficult in a consolidating environment for the central government to carry on with Capex or increase allocations to Capex materially beyond nominal GDP growth rate any further. So I would say that 3% of GDP, 3.1% of GDP, if they're able to hit on a consistent basis, with some being passed on to states, and if states are able to execute, that's okay at this stage of the cycle when you're consolidating the deficit. I think that's the main thing to keep in mind, that you're ultimately consolidating the deficit, so your room to allocate to Capex is fairly limited.
Okay, just before I get your take on tariffs and policy, etc., Santanu, just keen to know, if you look at the budget from the context of the time when it has been presented, and for India important was to make yourself resilient to whatever is coming from the White House right now, and we're not quite sure what will. How do you see it in that context? You are, being conservative on fiscal deficit, you're shoring up your resources, you've also reduced some custom duties, which could be seen as placating any kind of tariff threats. How would you assess it in that context?
No, I think full marks in terms of where you are at the stage of the cycle and what you've delivered in terms of the budget, in the sense that one thing that has been missed by the market somewhat is that they're unwavering in terms of the deficit consolidation, and they want the debt to GDP path to be declining over time. So by FY31, the government wants to get to around 50% of GDP, which by our calculation at around 10.5% GDP growth rate will be maybe 40 to 50 basis points of more consolidation, and then flat on the deficits thereafter. Which means that you really have one more year of fiscal drag to go, and thereafter the economy can oscillate around it. Why this is important is because in a long life cycle of an economy, you want the fiscal room to boost when you actually go through another deeper cyclical slowdown, let's say, or to absorb global shocks, as you're pointing out. So I would say in that context, sticking on the path of consolidation was the right thing. Within that, if you thought that urban economy was lagging a little, and rural, there were some signs of pickup, both from we think that the agriculture crop will be relatively good this year. Food inflation should come down. That should boost real incomes in the rural economy. You're already getting to see a lot of transfer payments, especially targeting women at the bottom end of the income pyramid in the rural areas. from the state. So all of that should mean that the rural economy picks up. And then if you thought that the urban was lagging, you've targeted whatever resources you had towards that urban economy. So in the mix, I would say they've done a good job in terms of both sticking to the macro stability, which you pointed out, the macro resilience, as well as targeting the part of the economy which needed some support.
Okay, now let me come to the impact of tariffs. We've seen a pause today, which has shown some instant relief across asset classes, Indian equity as well, and across the globe. But there's no pause on tariffs with China. This is a 1-month pause. There's still some uncertainty about what comes next. In terms of tariffs and the scenario laying out right now, what's the Indian perspective or impact for the Indian economy that you see?
Right. So this is a very uncertain environment, and as you have seen, the tariffs on Canada and Mexico were slightly above expectations. Then you've seen a rollback. Our sense is that you're going to see a lot of this uncertainty going forward as well, and that's the mix within which the policymakers will have to act. Some estimates that we have had earlier was that if you had a 10% across the board tariff, and you haven't seen that yet, but if you really did see that across the board, you could have a slight amount of higher inflation, around 0.5% inflation globally, and around a point of GDP growth drawdown or lower. India would somewhere be lower in that bucket, and there'll be other countries who will be hit more. But within this mix, I would say the fiscal authorities have already done their job. I mean, they've reserved some ammunition if they really, really need to act. Two, for the monetary authorities, which is the RBI coming up later in the week, the change that you've seen in the currency stance has been at least very welcome in our view. India was in a very low currency volatility regime for the most of last year. You've seen over the past couple of months the volatility in the currency pick up, and you've depreciated quite a bit over the past month or two, but that is basically a catch-up depreciation in our view. So it should have happened possibly earlier, and then you're catching up now. But this is a good macro adjustment. At a time when your RERs were getting elevated, this is a good macro adjustment to have when you're in a cyclical slowdown. This will also give room to the RBI to go ahead and ease instead of protecting the currency, really. What you don't want is a sudden depreciation.
Santanu, are you penciling in a rate cut, 25 basis points on Friday?
We have a 25 basis points of rate cut on Friday, but more importantly, the liquidity easing, which we saw last week, was very important. Right, you've had RBI now stepping in and going in for OMOs, which is going to extend its balance sheet. That is going to create your reserve money growth, and that should help in the economic recovery into the second half of the year.